Nigerian stock market caved through the roof in March 2008. And just a little over 10 years since, treasury bills and naira bonds seem to have become the new game for investors and everyone on Market Street. So it's been 10 years in which the stock market has continued to get its bearings back, but the debt guys seem not to give up on the game, even as we see a lower level of yields on treasury bills and government papers. So the new game is also now changing, with the government chasing single yield on treasuries and bonds, looking to reduce the cost of government borrowing. But let's get a bit of a Market Street analysis. What else is there on Equity Street still there for investors, and how should you play the new game in town? Victor Chiazo is the head of research at FSL Securities and is live to us from our studios inside the Nigerian Stock Exchange in downtown Lagos. Victor, good morning. Welcome to the show. Victor, can you hear me, please? Okay, I think we trying to reconnect the audio there. The market has been the stock market was where the party was worse, but now the fixed income space is where it is. Yesterday, as you heard earlier, the secondary window short-dated treasuries traded averaging the discount high of about 9.8%, as we saw a new decline in treasury yields. Yesterday, Wednesday, the central bank conducted a primary market auction selling three-dated papers, 91 days, 182 days, and 364 days. And the stop rates on those papers also declined. 9.74% was the new level on 91-day treasuries sold. 10.75% for 182 days, and 11.13 9% was the stop rate on 364-day paper sold by the financial regulators. So the talk on the street was that the banks are now adjusting to the new directive by the financial regulator, the central bank, to increase lending by the banks to the real sector, in particular SMEs, agriculture, and a few other sectors such as creative industries. Victor Chiazo is back. Victor, thank you very much. It's good to have you here from FSL Securities.
Thank you, Boston. Good to be back.
Yeah, Victor, thank you so much. The stock market, the fixed income space is where the party is right now. So, but let's talk about news. Within the first 6 months, all eyes were on those two big telcos that we had listed, and everyone thinking that this is what all we need to hit a new horizon in terms of market sentiment. That seems to have faded out.
Yes, I think luckily we had two good listings for this year, but unfortunately the market mood was not as bullish enough to drive the entire market up. We had Airtel, we had MTN. We had some good runs from MTN after the listing by introduction, about 6-7 days of positive gains, was able to pull the market up. But outside that, we saw the market dip from the 8th day. For Airtel has not done quite as well as the market would have expected. But I think right now is the time to actually look deep to the market and actually cherry pick your stocks in terms of your investment. But the truth is that, Boston, yes, the party currently is at the fixed income space. But the reality is that the equity market is still there to give you significant returns. Because if you look at market over the years, the market has been in cycles, goes round in circles. So meaning there's always a time where the market is bearish and there's always a time where the market is bullish. So your ability to decipher what time to come into the market, picking your stocks, picking your blue chip companies, and wait for the market to bounce back. And I think the time is now for investors to start looking at the equity space against the fixed income space. For the fixed income space, the max you're going to get is about 13% in terms of yield, 13-14%, and you're going to have to wait for 1 year to get that return and get your capital back. But for the equity space, in 2 days you can get as high as 20%, depending on when the market moves. So I think right now investors should start looking at the equity space as against just focusing on the fixed income space.
Victor, are there any other news out there that I can trade with? Anything on the horizon that you think could be a major catalyst for the equity side?
Yeah, the equity space, yes, has been bearish for a while. We all know that the fiscal space is almost non-existent. We're yet to see ministers. I want to say here that I want to give kudos to the CBN. The CBN has actually been the major driver of activity in both the fixed income space and more or less the economy at large. In terms of where we see things going, looking at the upcoming MPC meeting for next week, for me, we would love to see CBN drop rates probably by 100 basis points, about 12.5%, to actually signal where its policy directions are heading and also complement the good work the CBN is also doing. I think what CBN has also done, look at yesterday's Treasury option rate dropping to 11.1%, clearly lower than inflation figure. So it shows you that the CBN is looking at reducing interest rates, actually reducing government borrowing and government interest expense. So with also its loan-to-deposit ratio circular, as well as its SDF circular, I think all these are signals that very soon the party in the fixed income space might come to an end, and investors should start looking at the equity space. So I think those are signals that we should be looking at, and I believe that once we get the economy right in terms of a fiscal space and have a bit of structural issues, I think structural changes, I think we might begin to see some head turn towards the equities market against the fixed income space.
Okay, so let's talk about earnings. The season is just getting around. Here, the notifications are coming on a daily basis about close period, what the interim dividends will be, if there's going to be any, board of directors meetings, and all of that. Do you think the earnings news and the buzz around it, the numbers are not yet out, but the buzz around the earnings from companies could be a game changer for us as we step into the far deep end of the second quarter?
Yes, the earnings season, half-year earnings and Q2 earnings are certainly going to be a game changer for a few of the companies. I don't think it's going to be a widespread change. We're going to see a few companies that must have done well in terms of their Q2 performance and their overall half-year performance. We might see some interest in those companies. I think investors will really be looking at companies that have actually done well in terms of their Q1 and hoping to complement that number from their Q2 performance, the likes of GT, the likes of Zenith, the likes of Access. And also, I think investors will be looking at companies that have a history of interim dividend payments. So at least, worst case scenario, even we don't see a turnaround in terms of bullish run, at least we can actually get some return in form of interim dividend. So I think that's where investors will be looking at. The likes of GT, Zenith, that paid 30 kobo individually last year. And that's the place where investors might be looking at. And if you look at dividend yield for the likes of GT, Zenith, UCAP, Dangote Cement, GT, Zenith and UCAP and UBA as well, they have interest dividend yields of about 15%, and I think that's quite impressive. And I wonder why investors are not looking in that direction. Yes, we're not sure of capital gains in the immediate, but with more or less some form of research or some form of guidance, you're sure that you might get some form of returns in terms of a dividend. So if you have a dividend yield between 13-15%, I think that's where you should be looking at, and the possibility of a capital appreciation once we start to get things right in terms of the fiscal space and the economy at large. So I think once we begin to see these earnings coming and we see some in terms of appreciation, in terms of numbers for their half-year earnings, we might see some traction in that space. Overall, the entire market might not see that bullish trend, but I think we might see some case of some isolated movement in terms of some of the stocks that are listed on the stock market.
Why do you think the next move by the central bank, of course everyone knows in the world that the best time for central bankers to cut interest rates is usually a July meeting or September meeting. That's from the US to Russia, whatever. do you think the central bank will make a move on the headline policy rate next Tuesday, the 22nd? And do you think this will be the way forward or the kicker for the equity space? And you said the folks at the fixed income space should start wrapping up because you think or you believe that the party will soon be over.
Yeah, I think, like I said, CBN has done a good work coming out with policies and circulars to guide lending to the real sector. This is expected to boost GDP growth in terms of the overall performance of the economy. For the next MPC meeting for next week, I think I would really love to see the CBN drop rate, like I said earlier, by 50 or 100 basis points to signal where they intend rates to be in the medium to long term. Looking at every other policy parameter and the global space, I think now is the right time to cut rates. We have oil prices above $60. We have our reserves above 45 for gross and about 44 for liquid. And we have the Federal Reserve, and we have ECB also signaling interest rate cuts. We have most countries in the advanced economies. We had France currently issued a 10-year bond with a negative yield. And with all this put together, I think now might be the best time to actually take opportunity of these global happenings. If the advanced economies are seeing yields, negative yields, I think most of them will be forced to look at the emerging markets and frontier markets and place a bet and take some level of risk. And say instead of paying the government to keep my money, why don't I take a higher level of risk and come to frontier markets or emerging markets like Nigeria? So I think these are good times. Currently, despite rates coming down in the fixed income, they are still quite attractive. But I think there's a level at which it's going to get to, and the level at which the equity market is going to turn around, and we might begin to see flow from the fixed income to the equity market. Though we might not see 100% tilt, but at least once there's a significant increase, we might see some activities in the equity space. So I think now is the time the CBN and is team needs to take the bull by the horn and actually signal to the entire market that now we're looking at dropping rates to below, or at least between 9 and 10%. I think that will be fine for now, and we'll see how things develop from there.
Well, perhaps I'm sure the central bank and the members of the MPs, I'm sure they're all taking note of the developments globally as we speak. Even as we speak today, Victor, two central banks have cut rates. The Bank of Korea, or South Korea, the Central Bank of South Korea today cut interest rate. The Central Bank of Indonesia just cut its own repo rate by 25 basis points. Everyone is looking at Jerome Powell of the U.S. Fed to do the same thing this month as well, before the end of the month. So it looks like this is the season. The Central Bank for South Africa, the SARB, will also be meeting this week, today, tomorrow. So it looks like what you're saying is on track. A number of analysts we've spoken to believe that this is the time to cut interest rates, to give a further fillip, to drive down interest rates and push more credit into the market. So what are you hearing, Victor, finally, what are you hearing from the market street about the new directive on banks to push more cash in terms of loans there to consumers in the real sector? Every day I listen to the radio, I'm hearing a lot of new banks with new advertorials, new radio jingles, asking blue collar, white collar, black collar, anyone without collar at all. You wearing a red one, I'm in a bit of a black collar. Says anyone, whether you have collar or not, you can get credit loans from their bank. So it looks like the game is on, is it?
Yeah, Boston, the game is on currently. The truth is that the banks, for a while, almost, would you say, almost lost focus on what they should be doing, and everybody just took flight to safety. The reality is that you wouldn't blame the banks, because if you look at what has killed most of the banks in the past, it's actually been high NPLs, and because most banks didn't take their credit risk analysis properly seriously, we had to see most of the banks go under. So I think going forward with this new circular, the banks may need to actually pay more attention on their risk rating and their credit analysis in terms of their loan facilities, because the truth is that the risk of higher NPLs might be staring us in the face if this is not properly handled. And if that happens, we might begin to see one or two banks also go under, and that will not be good for the Nigerian economy. So I think, yes, the circular is good. The banks need to lend to the real sector, but I also think we need to trade with caution so that we don't go back to the days where we have NPLs in the region of 30%, 35%, 20-something%. We've had some banks actually impressively turn things around, like First Bank. They're gradually turning things around in terms of reducing their NPLs. So we need to be careful that we don't create another monster that will go around trying to clean up in the years ahead. Once we can put, in terms of policy parameters around the lending and also fine-tune credit analysis, I think it will be good for the economy and it will be good for the market at large.
Okay, let's hope everyone has learned their lessons. The central bank must have learned their lessons as well. I'm sure the banks have also learned their lessons, and the creditors themselves. So let's just leave it there for today. Thank you so much, Victor Chiazor, the head of research at FSL Securities.